Good morning, Anthony. How are you today?
Great. Good morning, John. Thank you very much. Today, we're going to be talking about a pretty interesting topic. I just got the email. We're going to be talking about phony income. And this is a topic that drives me a little bit nuts because people think we have an income tax. And I don't think so. I actually don't think we have an income tax because this is generally how it works that I've seen and sort of how the law has devolved. We have the seminal tax case, Glenshaw Glass versus Commissioner. It's a 1955 Supreme Court case that inadvertently gave a definition of income, what the courts look at income. And it goes something like this. Income is something that is an accession to wealth over which you have dominion, clearly realized. And in there, you'll see that actually there's something where you'll see a statement like this. All income is taxable unless exempted. That is what the law is supposed to be. But in actuality, what the real law is, anything is taxable unless it's exempted. So now, John, I think you have some examples you'd want to share with us. First of all, what do you say of my theory of this? Would you agree with what I say that under our income tax rule, anything is taxable unless it's exempted? Would you agree with that?
Well, I got to tell you, Anthony, I think it's fascinating that you began the discussion today with the Glenshaw Glass case, because I was actually rereading that 2 or 3 days ago. If you can imagine, this is a case out of the 50s.
Yeah.
And I was rereading it a couple of days ago.
So was I. I was too. When you said this, I said, when you mentioned this topic, I'm like, I've got to take another look at Glenshaw Glass. Yeah, exactly.
Exactly. What is income? And what's extraordinary about the case is that, when President Eisenhower appointed Warren, to the Supreme Court, he later said, it was the damnedest fool thing I ever did or something like that. And the Glenshaw Glass case is extraordinary because by using the definition of any accretion to wealth or whatever, this has actually set the predicate years later for taxing welfare payments of Americans abroad in foreign countries. In other words, any accretion in wealth, then, as you know, the way the Internal Revenue Code is laid out, there are clear exemptions, gifts, and other types of things. But, this is an example of, another decision where nobody thought through what the consequences of it would be. And so gradually what happened, I think, was that, when the decision came down, nobody would have imagined that it applied to, for example, foreign welfare payments. I was reading an article about it once where the author said that for the first few years, it was restricted only to punitive damages and stuff like that. But we can see how, year after year, once you get tax people involved in this sort of thing, any accretion wealth. I mean, what this means, Anthony, I'd be interested in your view of this. Let's say an American citizen, a proud, patriotic, tax-compliant, Internal Revenue Code fearing American citizen is walking down the street and looks down and sees somebody has left a $50 bill there. He picks it up. Question for you, Anthony, does that have to be reported on his tax return, yes or no?
That would have to be reported on a tax return.
I would agree with you. I mean, that shows absolute absurdity, right?
Yeah.
Now,
well, John, if you could just back up, because this is always something that I found interesting. We sort of have a weird definition of accretion to wealth, what we define wealth as. And it goes something like this. Well, let's just say this. I am a single guy, and let's say that I meet the girl of my life, the girl that I want. And she's wonderful, and everything's wonderful. And we have a family. Would you not say that I had an accretion of wealth? I'm a far wealthier I'm a far wealthier person because I have this relationship. And not only that, let's say this, John, that not only do I have this fantastic relationship, but I'm actually a very shrewd person. And I know how to get things cheaper than they are. So I always can go and find the best deals. So I am accretion to wealth all the time because I always get the best deals. And not only that, I also am very productive on myself. I've built a mansion with my raw hands with my own materials. So I live in a multi-million-dollar house, and I've had an accretion of wealth, yet if you look at this, I have an incredibly wealthy life. There's actually no event in there that's kind of taxable if you think about it. Now, the reason why I bring it up is I wanted to talk about something else. Let's say that you are running for Senate. You're going to run for U.S. Senate. And we know that the going price for a Senate seat would be about $100 million, because that is what certain people have paid for in their campaigns, about $100 million to get a Senate seat. So when someone becomes a senator, they get a wage. But not only that, they get everything. They get power. They get so much power, I could put a market price on that power. That market price would be $100 million, because I know somebody is willing to pay $100 million for that seat. So the question is, as soon as someone is elected senator, they should be presented with a tax bill, because they have a $100 million benefit. So why? You see, it's a funny definition of accretion to wealth. It's only certain things. And other things we don't even mention. It's like, well, that's not even an accretion to wealth. It's like, but are you kidding me? I have everything in my life taken care of. I'm incredibly wealthy. And you're saying nothing that I have is taxable. And then I go get a job, and I guess my wages as a senator would be taxable. But the real benefit, everybody knows what the real benefit is. It's the power. And that's something that I think is sort of out of the conversation. It's a very wealth defined by the Supreme Court is pretty small. It's not a real, it's such an incredible reading of the word wealth when we know things have a value that we could put to. Now, what do you say about what I just said there, John?
Well, Anthony, I think you make some incredibly interesting points, and I have no doubt that there may be some people listening to this podcast who think so far this is absolutely ridiculous. But it's actually not ridiculous at all. There are plenty of countries, for example, that will tax imputed rent, right? In other words, let's say that you own a piece of real estate. Let's say that it's vacant, right? What they will do is they will impute rental value to that, right? You could have rented that for $2,000 a month or something. We're going to add that to your income. Let's talk about your example of marrying the woman of your dreams, or whatever it was you just said.
Right. Well, we know.
This is quite interesting. This is quite interesting because let's say that say you were to marry a wealthy person, okay? And let's say under the laws of the jurisdiction where you live, you're entitled to half that person's income or half that person's wealth.
Right.
This is very, very dangerous stuff. But I think that going back to Glenshaw Glass, at least at the time, remember, this is the 50s, right? The Leave It to Beaver era, the Eisenhower years. Okay, I think that what they understood was basically if you receive something tangible is probably what they meant. But what's interesting is that the way the U.S. tax code has evolved, there are all kinds of examples of you're not receiving anything tangible, you're not receiving anything at all.
Except sometimes
you did receive it for tax purposes, right? And this is particularly true of Americans abroad where, go to court or somewhere and everybody says in their wisdom, Americans abroad, they may have to file, but they don't really pay taxes, for this reason or that reason. But actually, what's interesting about the situation of Americans abroad is maybe Congress realizes they don't pay taxes. Maybe that upsets them. And so what Congress has really done for Americans abroad and their beneficence is said, at your core, you're not paying taxes because you don't have enough income. So you know what? We're going to give you some income for you to pay tax on, right? That's what they do. And this is what I mean, for example, as fake income. One of the greatest examples of all time, and I'd be interested, if you agree with me on this, but the greatest, most recent, the bestest example of all time fake income would have been the Transistion Tax in 2017, right?
Yep. Yeah. That was completely
unbelievable. Fake. All these years from 1986, we go along, we're perfectly aware of what you're doing. And and whatever you're doing does not meet the definition of income under U.S. tax rules at all. But now what we're going to do is we're going to pretend you received all that even though you haven't, and we're going to add it to your income and make you pay a huge tax on it, right? I mean, that seems to me to be fake income. What do you think, Anthony?
Absolutely, that's completely fake income, and this is the thing that people don't realize. The IRS will send you a bill even though you didn't get the money. It's easy to get a bill. I'm working a case right now where the taxpayer owes $110,000 for purchasing stock. For purchasing stock.
I mean, Anthony, this stuff is
and now I'm trying to figure out a way around this that doesn't involve an offer and compromise, because I have that option. But you see it and you're like, you got to be kidding me. Someone bought stock and you're giving them a taxable event. That's another thing that happens. And so this idea, I mean, the Glenshaw Glass Test, and I think this has always been my frustration with it, that you can't even walk 10 feet before you run into something that clearly goes against it. Like, wait, that can't be the law because this clearly runs against it. I would say this is something that I read in the commentary. At the time in 1955, Glenshaw Glass was not really thought of a big case. It's only in retrospect its importance was inflated because it ruled in the government's favor of anything we want at any time that we want to tax for any reason we can.
Well, that's exactly right. It's very much like, let's say, the F-bar rules in 1970. You know, I think that people, in fairness, imagined that, I mean, first of all, $10,000 was money back then.
Yeah, right.
You know, they imagined that it would
today.
Be applied sort of minimally or restrictively. But then over the years, when people forget the purpose, the intent of the law, and the context, if it's a case in which it was decided, all of a sudden people start reading this stuff literally, right?
Yep.
And then, of course, you have, the Obama administration coming along in 2008, and, they say, oh, my God, and they create the FBAR fundraiser, so, I mean, some governments will have a bake sale or something. The U.S. government wants to raise money, will go out and, issue FBAR penalties, right? But, I mean, there was such an inappropriate use of that, but it's another example of how, something arrives, whether it's a court decision or a law, it lies dormant for years and years until somebody discovers some way to impose it punitively on some group of people. Another fantastic example, both of fake income, all right, and of the principle I just gave you, would have been the whole PFIC regime, right? So the PFIC
the passive foreign income, absolutely.
Yeah. As you know, it's 1986. As a way to sort of, attack the anti-deferral regime or to create an anti-deferral regime. And, I don't know that anybody really paid it. And then all of a sudden in 2010, 2009, 2010, partly as a result of the offshore voluntary disclosure problems and partly for other reasons, all of a sudden people get the bright idea that non-U.S. mutual funds are PFICs, right? And so this is an example, first of all, of what I'm going to call this interpretation creep, right? Or application.
Yeah, right. Yeah, exactly. Interpretation creep, right. That's a good one.
What's fascinating about the PFIC, and there's another example of fake income. Because, I mean, this is astounding. Go and read that section of the Internal Revenue Code. And then all of a sudden there's this section that says interest charge on tax deferral, right? So the way this thing works, I mean, this is just like, you cannot make this stuff up, all right? So the way this stuff works for people who don't understand how the PFIC thing works is this, that they presume, all right, that every gain that's not distributed is the result of some kind of a tax deferral, okay? So what they then do is they say, well, you should have paid the tax earlier, even though you never received the money, right? Or even if the mutual fund never received the money.
Right.
So what they do is they say, well, first of all, we're going to impose the tax as though you had received the money during, a certain year. And then what we're going to do is we're going to impose an interest charge on that tax that you should have paid on money that you never received.
Yep.
And then they say, and just so you understand that we, the U.S. government, are fair and just people with respect to the issue of interest. Normally, interest would be just charged, in a usual benign way. But in our case, to make our point, the interest that we're going to charge on this is going to be compounded daily, right?
Yes, it is.
Not only, Anthony,
Yeah.
do we have fake income,
Yep.
but we have interest charges that are compounded daily. And now it gets even worse.
Okay.
Because let's say that you're, one of these poor Americans abroad who, actually believe that all of these things are mistakes, right? Okay. So what happens then is that the foreign tax credit rules, like if you look at the form 8621, you will see that the foreign tax credits are applied only to the actual gain, not to the interest charges that are compounded daily.
Oh my God.
Yeah, I mean, Anthony, you cannot make this
Can't be
stuff
any
up.
worse.
It is
Yeah.
incredible. So
Well,
not only, Anthony, do we have the fakest of fake income, right? I think that's how we put it, the fakest of the fake income. But we have interest compounded daily, which is treated as interest and not as tax, and therefore higher taxes paid in foreign countries won't be able to be used to offset that in the form of a foreign tax credit. Now,
there is one more thing to add on.
It gets worse.
I mean, it's outrageous, but here's actually the practicality when you're trying to do this. If you actually show a tax return with the interest compounding daily, like you're supposed to, your tax return will be a box of paper. It won't be a ream of paper. I mean a box. It will be a box of paper. And so it's actually something we have to talk to our clients about to say, hey, look, we want to just sort of go and sort of condense this because we have a box of paper to track these. And there's really no guidance from the IRS that says, yeah, you don't need to print out the whole thing. And it's sort of a question mark. And we haven't heard anything, and there are no penalties for an 8621 not being incorrect. But that's an issue that's going on. And I would say this for the people who are truly like, maybe we got a little lost in us talking about PFIX. This is sort of here's a really good way to think about this. John, I want you to imagine yourself, you are running a very successful ice cream shop in Toronto. And you have some really great weeks. And you have some really bad weeks. However, you are not allowed to use the losses in your bad weeks to offset your gains in your good weeks. And at the end of the year, you're taxed. That is, you're not allowed to take into account any of your losses. And you're thinking to yourself, well, now you seem to be taxing me on my revenue, not my income. Because I have these losses that went into the production of this income that you're not allowing me to do. Now, the tax code doesn't work on the weekly basis, but what it sure as hell does is yearly. That you have a loss in 1 year, you might not be able to ever use that loss. But boy, will they tax you on the gain. And they used to have something called income averaging. Income averaging would let someone who's in business for himself like, yeah, I know some years I make $1 million and years I make zero. And it's really unfair to tax me $1 million because, first of all, you're taxing me at a higher marginal rate than someone who made the same amount of money over a longer period of time. And also, I have losses. And so that is one of the areas of law where you encounter the most bitter resentment against this incredibly awful tax code. People have legitimate losses, and you saw it in the tax reform. Oh, we're not going to allow you to take that loss anymore. Yeah, I know you had that loss, but you really can't apply it because whatever. And you know what that is? That's theft. And that's theft. And now, John, we do have to go, but this is a great topic. We might have to pick this up.
Well, let me give you two more very quick.
Give me two more real quick.
Okay, and we can pick them up later, but here's two other great examples of fake income. For Americans abroad, there's the issue of phantom capital gains. And let me tell you something. Every American abroad, I think, is going to have to pay a tax if they sell their house. Because either they had a gain, in other words, they're tied to the U.S. dollar. Americans are not allowed to leave the United States and break the U.S. dollar leash. So their whole life is in U.S. dollars. Mm-hmm. So they can actually lose money.
Yep.
And the dollars and the money and the currency they live with and think about, but they can actually make money because of the exchange rate, right? So in other words, this, the up and down of the exchange rate almost always results in some kind of a taxable event. But secondly, what a lot of Americans forget is that the mortgage that they have is also a taxable event, because if by virtue of exchange rates, they end up actually paying off less in US dollars than they had borrowed, then of course that's a benefit, isn't it? Right? So they can actually end up having to pay a US tax because they paid off their mortgage, right?
Yeah.
And these are things that homeland Americans certainly don't have to deal with. And then, of course, one of the greatest, the bestest fake income event of all is if they say, I've had enough. I want to renounce my U.S. citizenship.
Yep.
And then the U.S. says, well, we're going to presume you sold all your assets and your pension plans are gone. You're going to have to pay a tax on those now, even though you never received 1 cent.
Even though you didn't.
So there's income, there's fake income, and there's the Internal Revenue Code of the United States. There is nothing quite like it.
So John, in conclusion, would you agree with me that we don't have an income tax? We have another tax. It's a plenary tax of whatever the government wants. Would you agree? What would you say?
I certainly would agree, but the question is, what do you actually, that describes what it is. The question is what to call it, okay? And I think perhaps change, at least with respect to Americans abroad, I think they should change the name of the Internal Revenue Code for the fundamental principles of asset confiscation. That's what they'll call it. The principles of asset confiscation as they apply to Americans abroad. How about that?
Yeah, and I will also say it's kind of funny they have that internal revenue, that word internal for expats. So I would say it's sort of more like external asset forfeiture division would be a more accurate name for the IRS when it comes to expats. And I mean, generally it's just asset confiscation because we are so far away from, when you simply don't, in the basic, when you don't allow people to apply losses they legitimately had in the production of business or allow them to average their income, you're playing games. And you're just saying, well, yeah, this is it, this is that. It's not income. It's just simply not income. So we're going to bring this topic up again, I think. And I hope we get some other, if you're watching this, please leave us your comments about other examples of things you think are fake income. And if you do believe our income tax code is truly an income tax code, please let us know. We'd love to see why you think so. As we get deeper and deeper into this, it just gets more and more. And I think, John, that's a great thing you said, the interpretation creep. We are so far away from an income tax. We are 1,000,000 miles away from the 16th Amendment. None of this is authorized by anything. However, we've seen that creep where basically the court said, John Roberts says, well, it's a tax. You can do whatever the hell you want.
Yeah,
Not even that it's an income. I don't even think he said it's an income tax. You didn't even get to that far. It's a tax. We can tax whatever the hell we want. And that's where we are.
Well, it is absolutely fascinating stuff. And, as what's his name? Adams' book, Taxes and Civilization, Charles W. Adams.
Great book. I love
As
that
goes taxes, so goes civilization. When the history of the United States is written, they're going to have, the tax code will have played a major role. There will be monuments in Washington. There will be the PFIC Memorial.
There it is.
Our museum. People will fly into D.C. and attend the Museum of Forms.
We'll give tours. John, you and I will give tours when we get rid of this nonsense.
Exactly. Right. Look at this form. They extracted all this.
Oh, my God, right. Well, fantastic. Well, John, thanks so much for joining me. Be sure to subscribe. We'll have some more updates going on, and this topic will probably be expanded. Thanks again for watching.